So today you're going to learn intermarket analysis. So if you learn this properly, you'll be able to trade just like the professional traders. And one very important thing, make sure you get your pen and paper out because I'm going to go really fast. Okay, so let's talk about that right now. So I'm going to cover the important principles you need to take note of. If you haven't watched the previous intermarket analysis video, you can go and recap, but if not, I'm going to do a quick recap, spoon feed you a little bit. 3 ways to analyze the markets. You don't need to copy me, but there are easier ways and also harder ways to analyze it, so I'm going to share that with you as well. And then we are going to compare currencies versus bonds versus commodities versus stocks and also versus crypto. Now, it seems like very tedious, very tiring. Okay, why am I learning all this? I just want to know what MACD number do you use, what moving average number do you use. If you want to trade just like retail traders, go and learn indicators. If you want to trade just like professional traders, then we can keep talking. So if you don't know what is intermarket analysis, basically you're comparing currency markets with stock market, bond market. Basically, you're comparing with other markets. So that's why it's called cross-market analysis. Basically, it is the relationship between different markets, relationship between currency markets and bonds, bond market and stock market. Some relationships are stronger, some relationships are weaker. They don't last long, just like you and your ex. So this means that relationships might exist right now, but they don't last forever, okay? So intermarket relationships change over time. Basically, they don't last forever. And if you look at many of the relationships in the past, you realize that during certain periods, the relationship will change. So for example, if two markets tend to move in the same direction for the past 20 years, but then this event happened, let's say your sugar baby just comes in, then this relationship will break. They're going to divorce. If you study the past 50 years, you realize that relationships will change when there's massive deflation, okay? Especially during financial crisis, where it's deflationary, right? So a lot of times after financial crisis, you need to check, okay, is this relationship still intact, or is it divorced, or is it broken? Later I'll give you some examples. And the second principle you need to know is that certain relationships will be stronger in certain market cycles. So if you watch my economics video, I talk about expansion, recession, trough and peak in the economic cycle. So during various stages of the economic cycle, the relationship can move from strong to weak to medium depending on the stage of the economic cycle. Okay, so strength depends on economic depends on the economic cycle. You cannot trade in a bubble, okay? Because nowadays markets are interconnected. If you trade in a bubble, you just look at forex market, you don't look at stock market, you don't look at commodities market, you're going to get stopped out a lot of time and you don't know what is the reason. And most retail traders, they are probably going to be like, maybe my indicator number need to change. And why do intermarket relationships exist is because a lot of hedge funds speculate on it. And also a lot of hedge funds, they use it to hedge. A lot of hedge funds, they run algorithms, okay? Algorithms that track the strength of these different relationships and then trade based on that. So as you already know, the liquidity provided by hedge funds institutions is a lot. If you want to master intermarket analysis, one of the most important things you need to learn is correlation, okay? So you can classify correlation into two main types. First one is direction. Second one is strength. Okay? So correlations can be positive and of course negative, and also random, okay? So correlations can be positive, means that it moves in the same direction. It can be negative, means that it moves in the opposite direction. And also if the two markets has no relationship with each other, then their relationship will be random. Okay? And correlation can also be weak, medium or moderate, and also strong. What you want to focus on are the strong relationships and also the positive relationships and also negative relationships. Don't make life so complicated and then look at this. So there are three ways to analyze markets. The first one is using correlation coefficient. If you haven't went through my previous video, okay, correlation coefficient, don't forget this. And of course the easier, lazy way, which I don't really recommend, is just look at it visually. I mean, you can use this to do a quick glance, but don't use this to analyze. Okay? Then the other way for you technical chart traders, okay, this is good for you, is to use this indicator. So if you use trading view a lot, you can actually insert a correlation coefficient indicator, and it's going to tell you whether these two markets, are they positively correlated most of the time or are they negatively correlated most of the time. And if you want me to teach you how to insert this into your trading view, let me know. It measures everything in terms of absolute number. So the maximum is +1 and then the negative is -1. It's the same thing. If the correlation is 0.8, just change it to percentage terms times 100%, then you get 80%. So basically it's the same thing, just that they express it differently. So don't get confused by that. And if you like statistics, you like numbers, Excel sheets, you can do what I do once in a while, is to calculate it manually. Okay, manually. Maybe you want to measure the correlation for 1 month between two currencies. So you take the closing price of every single day, take 1 month's worth of data, and then using Excel function, there's a correlation function. And press enter, and then you'll be able to find the correlation. But you know, if you want to make life simple, you don't want to do so much work, I would say correlation indicator, because you can look at it visually just like any other indicator. So correlation, you can measure it in terms of percentages. So a strong percentage will be anything more than 80%. You can go online and there's a lot of correlation tables and it's all free. And anything less than 80% is a strong negative correlation. Anything more than 80%, strong positive correlation. Anything less than 80, anything less than negative 80%, strong negative correlation. So you should focus on all these. Don't go and look at 10%, 20%. The relationship is not very strong. They are just on a one-night stand. So if you haven't watched my past video, let me do a bit of recap. So if I tell you that two markets, their correlation for today is positive 95%. What does this mean? It means that it's very strong, right? But specifically, what does it mean? It means that 95% of the time, these two markets will tend to move in the same direction. How about the remaining 5% of the time? The relationship is random. Okay? And understand that there's no two markets that are perfectly correlated, meaning 100%. There's no perfect relationship in this world. You quarrel with your husband, wife all the time, sometimes once in a while, and that's normal. So no correlation is perfect. Okay, that's another important principle. Make sure you write that down. How about for negative numbers? Let's say, for example, negative 75%. This means that these two markets, they tend to move in the opposite direction to each other 75% of the time. Then the remaining 15%, not 15%, I'm sorry. The remaining 25%, their relationship is, what's that? Random. Okay? If you're a currency trader, make sure you look at other markets too. stock market. Make sure you look at commodities market. This means that you need to go and get your basics right. What are the different commodities out there and how do they function? What drives these commodities? What affects the supply and demand? Who is the major exporter of commodities? Who is the major importer? Who are the major consumers? Who are the major producers? Know all these things, okay? And then make sure you look at bond markets, bonds. Also, go and learn properly the different types of bonds. What are bond yields? What are bond prices? How is it related to each other? So is this all? Let's say today if you are trading Aussie yen. Okay, if you're trading Aussie yen, you also need to compare with other currency pairs because certain currencies will tend to affect another currency because take for example, Canada and US, they are both trading partners, okay? So if the US economy goes down, gets affected, it's going to affect Canada as well. You need to look at the other pairs, like I said, those with strong correlations. Example, Canadian yen. As of the making of this video, the correlation is about 80%, which is okay. So is this enough? Not enough. Not enough. Certain markets tend to drive another market, and that market will in turn drive another market. So bond markets are going to drive stock market. Sometimes stock market is going to drive bond markets. So you need to know the relationship between stock market and bond market, relationship between bond markets and commodity markets with your currency, stock market with commodities market. How many relationships? Number one, relationship between currencies over here. Okay. Number two, relationship between currency and stock market. Relationship between currency and bond market. Number 3, 4, 5, 6, 7. And also add one more. Crypto. So if you like to open multiple positions at one time, you need to be careful because if you open many different positions in which the currency pairs, they are positively correlated to each other, what's going to happen is that you're going to increase your risk exposure without you knowing it. And also if you want to hedge your currency pair with another currency pair, you need to open different positions that are inversely correlated to each other. And also if you are a forex trader and then you trade stocks, you trade crypto, you trade commodities, the more you need to study other markets because if you open multiple positions in your whole entire portfolio and all these positions, they are correlated to each other, guess what's going to happen? If everything goes down, it's going to go down all at the same time. And if you want to hedge your portfolio, you want to do proper asset allocation, you want a balanced portfolio, you need to know which assets are inversely correlated to each other. But first thing first, before you learn currencies and stocks, currency with bonds, and all the other different relationships, the first thing you must learn is the relationship between different currency pairs. So let's say if you pair a higher yield currency, a risk currency, a commodity currency with a safe haven currency or a lower yield currency, you would have a currency pair that can help you track risk sentiment. Because your base currency is a commodity currency, it's a so-called risk currency. Okay? Even though interest rates have been cut in the past few years, it went from 4%, then down, then now to 0.1%. But it's still relatively higher as compared to yen, which is right now at negative. Even though the interest rate is lower as compared to the past few years, investors still perceive that this is a risk currency. Why is it called commodity currency? It's because Australia is a major exporter of commodities, for example, gold, iron ore, copper, and hence gold prices, iron ore prices, copper prices is going to move in the same direction as Aussie yen. Okay, so this is your safe haven currency. When times are good, this whole currency pair is going to go up because people are going to buy risk currencies because risk appetite increase, and they are going to sell off lower yield currencies, safe haven, to find higher yields. And investors would sell off the lower yield markets, not only to buy high yield currencies but also buy higher yield bonds, higher yield stock market. This is another reason why these different relationships exist. You know what I'm saying? If you compare Aussie yen with Canadian yen, in which the base currency is a higher yield currency. High yield currency and commodity currency, Canada exports oil, that's the main export. And our safe haven currency, Japan imports oil, and hence, when oil prices go up, during good times when inflation is high, Canadian yen is going to go up. When times are bad, these two currency pairs is going to go down. So if you look at the correlation between these two currency pairs, you realize that it's pretty strong most of the time. Today is about 80%, which is quite strong. And most of the time, you realize that these two currency pairs tend to move in the same direction. So to put things in simple terms, if you pair a higher yield currency with a lower yield currency, they are going to move in the same direction most of the time. So another correlation I want to talk about. Dollar index, okay? If you compare dollar with, for example, euro dollar, these two would tend to have an inverse correlation. If you trade euro, understand that euro is so-called anti-dollar. So basically anything that is non-USD is going to move inversely as compared to the dollar. And also because dollar here is the counter currency, and hence when dollar goes up, this whole entire currency pair is going to go down. Dollar index is going to move in the same direction with currency pairs in which the base currency is the dollar. For example, dollar yen, dollar Swiss. Just make sure that you check the correlation tables to make sure that the correlation coefficient is still strong. Make sure that they are still married, they are not divorced yet. And also another relationship I need to talk to you about is euro dollar and dollar yen. Now I see a lot of traders, they make this mistake of indirectly opening a trade in a third pair, even though they are not literally opening it. So what do I mean by that? Let's say if based on fundamental factors, sentiment factors, technical factors, you want to go long on euro dollar, okay? You want to go long. And let's say for some reason you want to short yen. So if you want to short yen, then you would buy dollar yen, right? Because it is at the counter currency. For some fundamental reasons, sentiment reasons, you perceive that, okay, investors is going to get out of yen, they're going to sell off yen, so the whole currency is going to go up. So let's say you open two positions in euro dollar, dollar yen, okay, long positions. There are actually two problems with this. When you long euro dollar, you are essentially shorting dollar, right? Yeah? When you are long dollar yen, you are buying dollar. So this contradicts with your dollar short. How come you are shorting dollar here and then you are having a long position here? Assuming that you want to speculate, you don't want to hedge. Because if you want to hedge, it's a different story. Let's say you want to speculate for a profit. This contradicts with this. And also the other thing is that if you open these two positions at the same time, you are indirectly opening a position in euro yen. So essentially you are buying euro yen indirectly. And if you switch to euro yen chart and it's on a major downtrend for some reason, then do you think it's a good buy? Not so much. And the second thing is that if you open two positions at the same time, you are paying the broker two times. Why not pay the broker just one time by trading euro yen? Of course, euro yen, the spread is higher as compared to euro dollar, but if you combine these two, sometimes it can become higher as compared to euro yen. Another thing is that if you times the price of these two currency pairs together, you realize that it becomes the price of euro yen. So let's say today, euro dollar, the price is what is it? Euro dollar price 1.21664 times the price of dollar yen, which is at 109.511. The answer is equal to the price of euro yen. So the price of euro yen today is 133. Okay, let's write this over here. 133.250. You times these two together, what do you get? 133.325. Now there's always a 1 to 2 pip difference, but it's pretty close. It's pretty close. So you can see that even if you times these two together, you are kind of like trading euro yen. You know what I'm saying? So this is another reason why you need to understand correlations. And also another main problem is that if you long these two currency pairs together, it just doesn't seem right, especially if you want to speculate, because most of the time, euro dollar and dollar yen, they tend to be inversely correlated. If you want to hedge, it is fine. But if you want to speculate and make a profit, buying these two positions at the same time just doesn't make sense. So after you have learned your currency correlations, you need to learn other things. And that is stock market, bond market. How does currency move with the stock market? How does currency move with bond market, commodity market? So, like I said just now, if you pair a higher yield currency with a low yield currency, Aussie yen is going to track the higher risk markets. So, stock market all around the world, they tend to move in the same direction because investors perceive that stock is a higher risk market, and hence they all tend to move in the same direction most of the time. So you can look at S&P 500, DAX if you're trading euro, FTSE if you're trading pound, Hang Seng Index. But to make things simple, you can look at S&P 500 as a start. So you realize that Aussie yen will move in the same direction with all the stock market. So the relationship is positive. Okay, positively correlated. So currencies with bonds, you can look at US 10-year Treasury yields, okay? And then pair it with, remember, your high yield currency with low yield currency. Your risk barometer currency pairs are going to move in the same direction as bond yields, okay? So basically, if you don't know the basics yet, when times are good, economy is growing, bond yields are going to go up. And hence, stock market is also going to go up. If you compare Aussie yen with gold prices, iron ore prices, copper prices, it's going to move in the same direction as Aussie yen because Australia exports these commodities. So whatever the country exports is going to move in the same direction as that country's currency. So if one day Australia decides to remove all of these exports and decide to export nothing else but cotton, just cotton, because the world needs more plushies, cotton to make clothes and all that, then what's going to happen? Cotton prices is going to move in the same direction as Aussie yen. Okay, so now let's look at the relationship between stocks and bonds, commodities. So again, we use our US 10-year Treasury yields. 10-year Treasury yields. It will tend to move in the same direction as the stock market. If you're a stock market investor, the more you need to know this, because bond yields, a lot of times, it tends to be a leading indicator for the stock market. This means that bond markets is going to U-turn first before the stock market. So when times are good, stock market is going to go up. Agree with me? Bond prices are going to go down, and hence bond yields are going to go up. Okay, so when times are bad, stock market is going to go down, and bond yields are going to go down, and bond prices are going to increase. And when times are good, stock market is going to go up, then inflation is going to push commodity prices higher, So stocks and commodities, most of the time, the relationship is positive or negative? Is positive. Same thing with stocks and bond yields. Now sometimes stocks will lead commodities. Once in a while, commodities will lead stocks. But as a general guideline, you realize that most of the time, especially during a recession, bond yields are going to be a leading indicator to the stock market, meaning bonds are going to U-turn first before stock market U-turns, then followed by commodities. Okay? So commodities that move in the same direction as the stock market, you have oil prices. And if you want to look at a basket of commodities, you can look at CRB Index. Okay? So you realize that most of the time, CRB Index will tend to move in the same direction as stock market. And CRB Index will tend to move in the same direction as US 10-year Treasury yields. So again, if you compare bonds with commodities, the relationship between these two, it is positively correlated. So one thing you need to know, before 1998, okay, what happened was that bond prices, they used to move in the same direction as compared to stock market. After the Asian financial crisis, the relationship became inverse. Before the 2008 financial crisis, the relationship between stocks and commodities, okay, they used to be very weak. Like they are half divorced, but then they are still attached. You know, it's very complicated. Relationship is complicated. But then after 2008, when financial crisis hit, you know how tough times bring people together. The relationship between stocks and commodities strengthened after 2008. So as for now, you can actually use commodity prices to so-called predict where the stock market is going to go, and use stock market prices to predict where commodities is going to go. But I will say this relationship is a little bit complicated because sometimes this one tends to lead this one will sometimes lead the other one, you know what I'm saying? But bond yields in the past has always been a leading indicator for stock market and commodities market. And like I said just now, the relationship between stocks and crypto, especially Bitcoin, it ranges from 40% to 75%, so it's not considered strong yet. But overall, the relationship between stocks and crypto, it is positively correlated, okay? By the way, if you are a beginner, complete beginner, don't touch crypto yet because it is super volatile. Because Elon Musk can just wake up today in a bad mood and then be like, I'm about to end your career. I mean, that's for now, unfortunately, but then in the future, when the liquidity increases, when more and more institutions take up cryptocurrency as a hedge or for speculation, then Elon Musk would lose power on crypto and maybe he's going to move on to something else like Dogecoin, Elon coin. Okay, let me go through a couple of examples. So what I need you to do is to pause the video, write down your answer. Only after that, I'll reveal the answer, then you compare. Did you get it right or did you get it wrong? If you get it wrong, it's okay because we all make mistakes. You know what I'm saying? What is the relationship between dollar index versus CRB index? Remember, CRB index is a commodity index that tracks commodities. It is a basket of commodities. So, is this relationship positively or inversely correlated? Pause the video now, write down the answer. Okay, so if you have written down the answer, you think about this, okay? Commodities, they are priced in USD. Agree with me? When USD becomes weaker, commodities become cheaper. And hence, investors see very cheap commodities. They are going to buy or sell commodities. They are going to buy commodities because it is very cheap. So when USD goes down, CRB index is going to go up. When US dollar strengthens, CRB index commodities is going to go down. So in the past, central banks, what they did is that they would try to weaken the USD just to push commodity prices up. So if inflation is going out of control, if it is going too high, central banks are going to try to strengthen the USD so that commodity prices is going to go down and also inflation will go down. It doesn't get out of control. So this relationship, most of the time, it is inversely correlated. It has a negative correlation. If I give you another currency, New Zealand yen versus S&P 500. Now don't cheat, okay? Don't cheat. Don't go and Google shit and don't cheat, okay? You can only eat Cheetos. So if you look at what's on the base currency, this is a commodity currency. What does New Zealand mainly export? Soft commodities, right? So you have a higher yield currency. High yield currency, so carry traders are going to buy New Zealand dollar and borrow yen to buy a higher yield currency, for example, New Zealand dollar. So when you pair a higher yield currency with a lower yield currency, safe haven currency, it's going to move in the same direction or opposite direction. Pause the video, write down the answer. What's the answer? It will be positively correlated to each other most of the time. So if you go back last year, March 2020, when stock market tanked, you can see the same thing happening to New Zealand yen. When stock market recovered, U-turn, you can see the same thing in New Zealand yen. It U-turn. So this relationship is quite easy. I would say it's quite easy. It's very easy for you. Let me just make it a little bit harder. Let's make it a little bit harder, okay? S&P 500 with this ETF. iShares high yield corporate bonds. This ETF, is it going to be inversely correlated to S&P 500 or positively correlated? The answer is, it is inversely. No, it's positively correlated. Why is that? But just now you said bond prices is inversely correlated to S&P 500. Yes, that is treasury bonds. Now we're talking about corporate bonds. So if you study bonds, if you don't know anything about bonds, there are many different types of bonds, right? Treasury bonds, corporate bonds, junk bonds, high yield bonds. Because corporate bonds, they are issued by companies, right? And hence, when a company is doing well, it's going to grow. So it is kind of like the same thing as the stock market. This is why both will be positively correlated to each other. So my point here is this. You need to study bonds. Study what are different types of bonds. You know, how does bond works? What drives bond prices? Also study stock market in depth. I've already done the stock market course on my channel. Go and find it yourself. Okay, another example. I know you might be trading this because it's a very popular currency. Euro dollar versus. Let's take CRB index again. So is it positively or negatively correlated? Positively correlated most of the time. If you look at European debt crisis, when euro dollar fell, 2010, early 2010, CRB index dropped a lot more, and it dropped at the same time. And when euro dollar recovered, CRB index also recovered. So this means that when a non-USD currency drops along with CRB index, it tells you that, okay, times are kind of like bad, not so good, when euro dollar is going up along with CRB index. So this is when inflation is increasing. And this is what a lot of retail traders don't know. Because they only look at one currency, they just trade this based on technical indicators. They don't know what drives the currency up. The only thing they know is, okay, because moving average is sloping up, yeah, that's it. Technical analysis have its time and place. Okay, but you cannot just look at technical analysis alone and use that to trade. Investors see this as a risk currency. Of course, some people might say this is a safe haven, but then most investors, they perceive euro as a risk currency. And when you have a risk currency as the base currency, so it kind of acts like, you know, the Aussie dollar, Aussie yen, the examples I showed just now. Okay, so how about oil prices? Compare this with, let's say, US Treasury, 10-year yields, okay? Treasury notes, yield. Does it move in the same direction or opposite direction? The answer is same direction, okay? Positively correlated. How about US 10-year yields with gold prices? Positively or negatively correlated? Positive? Positive? You sure? You're not paying attention. I'm gonna bring my cane. Positively or negatively correlated? What is gold? Safe haven, right? So-called second currency. You know, when people are scared, they are going to buy up gold. So when US Treasury yields go down, for example, what's going to happen to the stock market? It's going to go down, right? So investors, they want to find a safe place to park their money. Hence, gold prices is going to go up or go down. It's going to go up, okay? Because if you think about this, bond yields are down, right? So investors, they always want to find a place where there is higher yields. You know what I'm saying? So when yields are down, the interest rate is not that attractive anymore. So investors are going to withdraw their money from the bond market. Remember, capital flow, very important. Withdraw money from the bond market and then park their money into gold. So you need to understand that gold is not like other commodities. Even though it is a commodity, it kind of operates in a different world because it functions as a safe haven and also at the same time an alternative currency. It's very different from oil, right? Okay, alternative currency. That is why you cannot put everything together. Okay, gold prices, oil prices, coffee prices, orange prices, natural gas prices is going to move in the same direction. It's different. And there are many different ways to track gold prices. You can look at gold spot and also you can look at ETFs. One example is SPDR, Gold Trust. Okay? So let's say if you look at another currency pair and that is pound dollar, comparing it with, let's say, oil prices. Let's say UK oil. Is this relationship positively correlated or negative? If you think about this without cheating, about 10% of UK's GDP is contributed by what? Energy production. And hence, when oil prices strengthen, what's going to happen to pound? It's going to benefit the UK economy and hence, these two markets are going to move in the same direction most of the time. What's the correlation? Positive, okay? When you study a currency, you also need to know what the country exports, what the country imports. So this is why you need to study fundamental analysis. What is the fundamental reason that drives a currency? Okay, you gotta study what are the country's major exports and also imports. Okay, and also of course the economic indicators, and is the country's financial markets attractive or not, because this is going to affect capital flow. Financial market attractiveness. And also number 4, what are the that country's central bank's mandate? Basically, what is their job? To reduce employment, to control inflation, manage inflation, or to prevent the currency from strengthening. There's a lot of different mandates. Also, whether this currency is a popular reserve currency or not. Is it being held by central banks all around the world? Basically, amounts of reserves held. These are some of the factors you need to study before you even trade a currency. And what else? Is the currency perceived as a high yield currency, a risk currency, or is it perceived as a safe haven currency? So maybe this one for another video. Actually, I've covered this in the past, but maybe it's for another video. I don't know what title to put this at, but we'll think about that next time, Cam. So I hope that this crash course helped you understand the different types of markets and how do they move in relation to each other. Do you want more fundamental analysis video, sentiment analysis, or intermarket analysis video? Let me know down in the comment section below. Okay? So with that, I'll talk to you in the next video. Bye.